Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Past guests include Brooke Reuter talking about contract for deed versus lease to own options, Scott Rees, the Chickasaw Community Bank, talking about commercial banking options. And we just had on Will Gilbrecht of Franklin Heating and Air out of Northwest Arkansas, one of the fastest growing HVAC businesses in the country, talking about all the complications of HVAC and servicing equipment in summer and winter. Super interesting podcast where we talked about home warranties and why they suck. I hope we don't have any home warranty people that are listening to this or want to come on the podcast. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. John, Kyle, you both are real estate investors, and you know exactly what I'm talking about when I say it's hard to line up contractors to get a make-ready done in a reasonable amount of time after a tenant leaves a property. Sometimes they leave it in not the best of conditions. But, contractors are busy. The work seems to drag on forever, and all that leads to lost rental income. At Keyrenter, we line up our dedicated vendors so that turns can happen super quickly, and we get more money back into the pockets of our owners. And on that topic, we're going to have Tom Watkins of our maintenance team come and explain how we do make-readies and why we do them super effectively. He's going to be on at some point in the near future. But that is why no matter what rental you have, single-family homes, condos, townhomes, apartments, we have the management solution that you need. Go to keyrenterpmc.com or info@keyrenterpmc.com. Before we introduce John and Kyle, I'll say John and I originally met at BNI. BNI's Business Network International. It's a great networking organization where it's a referral-based networking organization where each person or each seat is designated for one professional classification. So there's one property manager, one attorney that focuses on divorce, one that focuses on whatever, and then, a CPA and a contractor and whatever else. And it's, passing referrals back and forth. So John held the commercial insurance seat in our chapter for a long time. And that's how we built a relationship originally. So I'm grateful to BNI for having connected us together. The other thing is that John, a real estate investor, is stuck his neck out and bought a very risky asset that he did a beautiful job turning, renovating, and ultimately sold it to one of our investors. So we still manage that property over by the Quick Trip at 11th and Utica. So happy that he was able to do all that hard work and capitalize on some of the value that he created. Let me do a quick intro. John Melton is a military veteran, commercial insurance broker, entrepreneur, real estate investor, and multi-time business owner. He's also an aviation enthusiast, which is how we recently reconnected, and I love talking aviation. So anybody that wants to come on and talk general aviation, I'm always open to that. But he's a longtime insurance broker with RCI Insurance. And Kyle Beggs has been in the commercial insurance world for 10 years. He's also a real estate investor with over 25 doors. John and Kyle are partners. And with having bought into the business in 2016, Kyle and John have a unique perspective on insurance because they both write insurance on a commercial basis, and they also pay the premiums as investors. Kyle's a native of Claremore, where he lives with his wife and his two boys. Kyle, John, welcome to the show. How are you?
Doing great. Thanks for having us, Matt. Really appreciate it.
Good to have you on. Yeah, tell us a little bit about how you got started in commercial real estate. Commercial insurance.
Commercial insurance. I got out of the military a little over, I guess it was 8 years ago at this point. I was a part-time, or I guess you call it a weekend warrior. And I was doing sales in the industrial supply space, looking for something different. Kyle and I went to college together. Reached out and we kind of formed an agreement and started working together. So that was 2016, October of 2016, I believe, and been doing it ever since. I'll say real quick, I have Kyle and insurance to thank for my entrepreneurship. Us as commercial insurance agents, we deal with nothing but entrepreneurs, good, bad. Mediocre entrepreneurs. We see all of it. So, again, insurance is really the thing that set me on that path. So
I love it. Kyle, you've been involved for just a couple of years longer than John has. What got you involved?
Actually, I graduated college in '09. A great time to try to get a job with no experience. And so had a couple of buddies that reached out to me and said, "Hey, man, you'd be good at insurance." And I said, "No, I'll never sell insurance."
Yeah, is that a
And
compliment?
it is never say never. And so I dug into it. And my dad was my hero and a guy I've always still to this day look up to a lot. And he was an entrepreneur, and I loved how he thought. And fast forward to today, I couldn't think of a better business, man. I love you get to be surrounded by guys that started out of their garage and now have 100
Yeah.
plus employees, or
Yeah.
whatever the case is. So kind of fell into insurance, and then kind of lucky I did.
Yeah, I love it. I mean, you guys get to see the back end of all sorts of businesses, and frankly, through the sales cycle and then through the audit cycle. For anybody that's listening that does not know commercial insurance well, on the general liability side, for sure, you're kind of understanding what sort of revenue a business is doing, and then get audited on the backside to make sure that the coverage was appropriate, and they can either give you a refund or charge you a little bit more based on the accuracy of your prediction for a year. But you really get to see real numbers. I mean, a P&L for all sorts of businesses. That's a pretty cool look under the skirt, so to speak. Let's talk about RCI. What kind of insurance do you guys write?
Well, we kind of, we specialize in commercial insurance. I would say the majority of our firm, that's what we do and have our staff built towards. But we've got a full department that does group health for businesses. Wow. And then we've got a full personal lines department that does a lot of our business owners or just anyone else's insurance in that case. We're an independent broker. And so I think what our biggest advantage is that we're going to shop it out with probably over 20 companies, and try to get the best rate for the best coverage. And so that's a little bit about us.
So John, you guys will do for John, anything?
No, the difference in us and a State Farm agent is, or any other farmer's agent, anything like that, is we are a broker. We're not tied to one company, so we shop the market depending on whatever the risk is.
So for our listeners, anybody that owns a business, we should probably touch base a little bit on general liability insurance. We should probably touch base a little bit on workers' comp, and then predominantly, what I'd love to focus on is property insurance for big multifamily stuff. So we can talk about certainly single family and the nuances there, but I'd love to touch base on the commercial insurance of multifamily properties, because that industry has seemingly gone up and up and up for the last, or the pricing has gone up and up and up for the last number of years. And we often have clients that come to us and they are pro-forming out a property. They say, I've looked at the trailing 12 numbers. This property, this 60 unit property is paying $45,000 a year in insurance. I think I can knock it down to $25,000. At least that's what the listing agent told me I can do. And I, frankly, I roll my eyes a little bit, but then I understand that, if this doesn't happen, the numbers aren't going to pencil out. They're going to start squeezing us on management fees and looking at us for, cost cutting measures and encouraging us to not change hot water tanks when they go out, so to speak. And pushing deferred maintenance and all sorts of other stuff. So let's talk commercial multifamily insurance. What's the state of the industry? Where are we going price wise, just generally?
Well, I think most agents and insurance professionals in our space would agree. 2023 is expected to be probably the hardest market that we've ever seen. Just to kind of start out with some somewhat bad news is there's a lot of contributing factors that are going into that. But when I say a hard market, we mean the appetite and how much companies are willing to work with clients in order to write their business. That is getting more and more difficult to do, and there's less and less companies basically vying for that business as well. So one of the biggest things that we can attribute to what we're expecting to be a large increase over the next couple of years is Hurricane Ian. Number one, Hurricane Ian is going to go down, at least until the next one hits, as the costliest storm in United States history. I believe it may be in history of the world, more than just from the cost on insurance. So,
and why does that
alone?
Why does that cost impact insurance in Oklahoma?
Well, it really comes down to the insurance market as a whole. All these companies do business in multiple states, and now Oklahoma is a landlocked state. We don't have that. What we do have is large wind and hail claims all the time, but what you're looking at is the profitability of these very large insurance companies as a whole. And whenever they're I can't remember what the last estimate was for Ian, but I believe it's north of $100 billion in payouts. Someone will probably fact check me on that and tell me I was wrong, but it's just a very hard to almost wrap your mind around number. And first and foremost, that's what.
Well, I was going to say, FYI, 112 billion is where it's at currently right now, from the latest estimates from Google. And the other thing I'll throw in there with John is that you have all these national carriers, and I don't care if it's Hartford Travelers, State Farm, Farmers, you name it, they're all have a piece of this property market. And let's just take one of them. Let's just say that Hartford has, a certain amount, so much insurance that they insure nationwide. At the end of the day, they don't insure all that. All these carriers go on the back end and do what's called reinsurance, where they don't have to take all the risk up front.
Right.
They're going to charge something for the premium, and then on the back end, people are going to use the reinsurance, so they spread out that risk. And that's just insurance as a whole, right? You put everything in a bucket and collect the premium, and hopefully that not everything is going to go wrong at once. And so at the end of the day, where you're seeing a lot of our markets harden and take a rate increase, we're seeing it a lot more because the reinsurance markets have really tightened up. It's not necessarily the carriers.
Interesting. But so what happens anywhere nationally in terms of large scale claims affects the market everywhere.
Absolutely.
And when you say that there are fewer carriers that are willing to look at that Oklahoma multifamily risk, for example, and write that risk, are we talking 5 carriers that are still looking at stuff, or are we talking 2? I mean, how much? Essentially, it's a supply-demand dynamic, right? If there's only one carrier, they can write whatever they can name the price. You either want insurance or you don't. You're either going to be in compliance with your mortgage documents or you're not. And if there are 2, it gets a little bit better, and if there are 10, much better. So, I guess 2 questions: how many carriers are writing stuff right now, realistically, roughly, and at what point does real competition where pricing can come into effect?
So that's a hard question to answer because each carrier kind of has a market niche that they specialize in, right? And so you've got some carriers that'll do single dwelling, and that's all they kind of focus on because they know that really well. I've got other commercial carriers that they won't ever touch a single dwelling. They'll only do your big apartment complexes. And then you got some regional carriers that will do, hey, your quadplexes, your in-between. And those are what we call your standard carriers. That's what we always want to use if we can help it. But then you open up a whole nother door where there's called excess and surplus, where then all of a sudden, if the standard carriers won't write it, you have all these other carriers that will come into play. The coverage isn't as good, and the pricing is going to be worse. And so it's kind of a hard question to answer because they all niche out in different areas. And then you've got the excess and surplus lines that add to it. And, the other thing that I'll add that goes against us is that when you're talking Florida, Louisiana, those are some of the hardest hits property markets go to the coast. But Oklahoma, if you look at true loss ratio and what we collect in premium, ranks right up there with Louisiana and Florida, just because of our wind and hail that we deal with. And so you also have that factor that you're leading to, Matt, that we have limited markets. What you would have in Minnesota and up in that area, you have a lot more opportunity for carriers to jump in and quote your insurance compared to an Oklahoma and a Florida.
Fine. So Florida might see more dramatic spikes in their losses, but Tulsa or Oklahoma in general has a more sustained but higher ratio of losses because we have more frequent events. Is that right?
Correct.
So if we're comparing, if a client of ours is talking to a commercial insurance agent on the multifamily side and they're comparing two policies that seem to be similar but may have different pricing, what do they need to look at when they're comparing those policies? You alluded to some of the, differences in coverage, or one policy maybe having worse coverage than another. What are some of those nuances?
Well, one of the most important things there is going to be the terms, basically the fine print as well. That's another contributing factor that we are going to see with what we already are seeing, and what we'll continue to see with the market is the terms in which these policies are written on are much more stringent. Like Kyle and I discussed before we got on this podcast. You're starting to see vacancy clauses on a lot of these properties. So let's say it's a single family home or a duplex. If it's completely vacant and something happens, there's potentially no coverage. Things like that we need to be very cognizant of. On top of that, one thing that your viewers may or may not be familiar with is coinsurance. Coinsurance, which is very different from the medical side of things. People think coinsurance, they pay their portion, I pay my portion. No, coinsurance with property is did over should, what it should be insured for versus what we're actually insuring it for, based off replacement cost or cost of rebuilding. So, one thing we could go off of with all property is a price per square foot. On the residential side, we're seeing, what's typical that keeps on increasing, anywhere from, $120 a square foot to $150 a square foot. That's what they're looking to insure it for. Historically in Oklahoma, we as a part of the country underinsure a lot of things based off replacement costs.
Well, and I'll just piggyback off John on that and tell you that there's so many times the conversation we hear, Matt, is, hey, I bought this property for, $2 million and you're trying to insure it for $4 million. I wish that thing would burn down. Why are you trying to insure it for that? So that's not even close to what I paid for it. And, I think that, people got to realize the two biggest things I'd always look for in a policy is it actual cash value or replacement cost? And at the end of the day, you always want replacement cost if you can help it. There's scenarios where you should do ACV, actual cash value. But, if you're doing a replacement cost, it's not what it's worth. It's what it would cost to build a brand new building in the 2023 standards. And so a lot of people miss the boat on that part of trying to create an insurance value, or what to insure it at. And as John was kind of alluding to, most people, we bring up coinsurance and they think back to their health insurance, but coinsurance is a kind of a checks and balance for an insurance company that says, hey, if you don't have this insured to the value, we're going to penalize you. And I think we all know that if the insurance company has a penalty on you, who's going to win and who's going to lose in that situation.
Yeah. Yeah. Interesting. Is there, what are the scenarios where actual cash value is an appropriate insured amount as opposed to replacement cost?
Yeah. So I just met with a client last week that the real estate they have, the land, is way more value than the actual building. And so what we did is if we did a normal insurance policy and did a replacement cost of what he needed at, he's going to get hit that co-insurance policy.
Yeah.
Because he does not want to rebuild there. He just wants to have that value of the land. If something happened to it, he'd sell the land. And so in that case, do an actual cash value policy to where you get the value of whatever that property is on it, but then you still have that land that you can sell or go through. And the other aspect you would use that in is if you had a large building, like an office building, and you said, with the office going down here in the last couple of years, you go, man, it's 30,000 square feet right now. If something happened, we would probably build back 15,000 or 20,000 square foot. Well, At that point, you don't need full replacement cost. It makes no sense to pay the premium for that.
Interesting. Super interesting. Is there anything that an owner can do so that they look better to underwriters, so that, when they ask for a quote on whatever it is, an insured multifamily property or whatever, that they can actually get better rates for that insurance?
Well, that's kind of a hard question to answer as well. One thing that they do look at that our clients need to be cognizant of, especially moving forward, is their 5-year loss ratio. So if they, if someone's buying a brand new property, they have under a certain entity, they have no, insurance history, they're probably in a pretty good spot.
Kyle, what are some things that owners can do to look better to underwriters that they increase the odds that they get better rates on commercial insurance for like a multifamily building?
Yeah. So, one thing that an underwriter, the very first thing they're going to look at is they're going to know your losses. They're going to know the losses of the last 5 years. And they're going to look at it per se that, hey, if we've got, $1,000 just for simple numbers of premium every year, and then they're going to look at what percentage of that premium was paid to losses. And so, if you're over a 50% loss ratio, you're not going to look great to them, and so you got to think about that when you're filing a claim on a roof or whatever the case may be. Hey, I've had like 3 or 4 little claims I've had to, claim before this, because it's going to affect your loss ratio. We always say that, insurance is almost like a financing policy that, we'll pay for it up front, but you're going to pay for it on the back end. And so I always say, just be careful, be cognitive of that loss ratio, because I've got a client that's got, 70 properties spread out throughout Kansas and Oklahoma. And for the last 5 years, they haven't had any claims. This last year, they had like 6 or 7 claims over $250,000. And so we're going through a review with them. And I just said, hey, guys, if there's something that gets close to that deductible, pay it out of pocket. Let's get this loss ratio cleaned up, because that's what every underwriter is going to look at. And once we get that good, start filing claims and be a little more clear with it. But I think that people sometimes lose the strategic part of that be strategic and know what that underwriter is looking at. The other thing I would go ahead.
No, go real quick before you get to the second part of that. If you have a single asset entity, meaning I'm starting an LLC for the acquisition of a specific property, you've got no history. Do they then go back to the members of the LLC and try to run the loss history, or do they just somehow account for it, in the middle somewhere? It's not that you have no loss history. It's not that you have tremendous loss history, but rather we just have to assume that you're the average of everybody in our network.
So, man, great point, because in that scenario, it's our job to tell that story for you, right? The underwriter's just looking at an email and looking through paperwork on his desk and looking at that loss ratio. And so if he's got that one property, let's say that he's got that LLC in, I'm going to go back and say, hey, here's all the experience he has. He's got all these doors he manages. Here's the loss ratio on those other properties, just so you can know how he runs his operations and how he does business. We want to sell that story to the underwriter. And so, in that scenario, we want to use your experience or what you've been through to kind of give you the best rate you can, because you just go into it and say, hey, it's a new entity, new building, no losses on it. They're going to give you not the best price because they have nothing to go back and look at your history. So in that specific scenario, we want to go back and really fill in the underwriter, your experience and what you've done on your other properties in the past.
But then doesn't it make sense that an owner that has significant loss history on, one LLC where they've got 15 or 20 properties just opens up a new LLC, puts 15 or 20 properties into that LLC and just tries to get insurance rewritten?
It can, but here's the problem you're facing with that is that, 20, 30 years ago, you could do that pretty easily. Now, just like your MVR is connected, and any insurance company that quotes it can pull up your MVR and see what what tickets you've had or accidents. Same thing goes on that commercial insurance. They're going to pull those loss runs, and they can pull in that address and see, now hold on, this has had 2 roofs, this had a liability claim for a slip and fall, and have this. Is this a new owner, or is this just new LLC? So technology has really taken a lot of that out of play.
Yeah. So they say not only are you've been dishonest and you're trying to trick us, you're manipulating the situation, and therefore we can't trust what's going on here. I get it. And you're going on to a second point about the odds underwriting.
The other thing I was just going to bring in with that is just to have, just like me and John were talking earlier on the co-insurance part, have the replacement costs to where it needs to be, have the values where it really needs to be. And then the other thing is, have the property look as good as you can. They're going to look at that. A lot of times they're going to take pictures. Other times they're going to send out a loss control and look at it. And that's such a huge, that really show to the insurance company. They look at that if you're taking care of this property, you do things the right way. If you're just, hey, delayed maintenance, kind of like you were talking on the intro, waiting for, we know that we're going to get hit with that claim sooner than later. Someone that's being proactive and taking care of the properties, those underwriters pay attention to that. That's the type of clients they want.
Yeah, absolutely. Let's switch for a second to perhaps a less comfortable subject. Your comp as an insurance broker is directly tied to the cost of a policy, and that's maybe more of a generic. I don't know how RCI, is actually comped on things, but generally speaking, insurance agents for whether State Farm or a big commercial insurance agency would be comped based on the policy that they write. So there's naturally a feeling for the person that's purchasing the insurance that, hey, my insurance cost has gone up every single year. And while the agent's working super hard to shop it around, there's also some underlying, potentially some incentive to actually not give the best rate or whatever, because the agent actually can make more money. Let's talk about how you guys make money, how you're comped for the services that you provide, and how you address that potential feeling of a client that you're making more money because they're paying more money.
Yeah. At the end of the day, Matt, that's the elephant in the room, right? If your rates go up, your insurance agent's getting a pay raise every single time. And I do think that's what is unique with probably me and John's situation of being on both sides of it. We've been on the insurance side and we've been on the investor side of having our own real estate. And, I can tell you that if you've got 4 or 5 single home properties, probably the agent's not going to look at this. But I can tell you that me and John both personally have some clients that have multiple properties. It ends up being, a significant amount of premium. And then we know that, and we've been on both sides of it. And so one thing that we do at RCI is a lot of times your agent's getting anywhere from 15% of that policy to 10%. And so what we've done is that at a certain mark, at a certain premium, the work's the same for us as an agent. And so as you add, properties or things go up, it's still the same on us. We shouldn't get paid more, because of that. So what we've done is do just like a flat fee. We do a flat fee that says, hey, here's what we are going to charge to manage everything for you. And then the thing I love about that is that the insured can see that piece of premium we're not taking as commission goes back to them as a credit on that policy. And so it just kind of takes that elephant out of the room that if rates go up or down, it doesn't change my pay. I'm going to work for you no matter what. It's a
more, I guess, direct incentive.
Basically open book,
transparent. Yeah.
Yeah.
Just try to be transparent with it. I think that's just be honest.
Yeah. How have property values and replacement costs affected things recently? Very clearly, inflation being what it is, and obviously the replacement cost of stuff has gone up so substantially, so the premiums have to go up to match that potential loss. But how have rates kept up with insurance, or are they knowing that with inflation, I meant to say, or is it like the insurance rates are going up in advance of inflation, knowing that it's coming down the pike? What's the story with that lately?
It's a little bit of both. Frankly, we've already seen a lot of inflation affect us with the cost of labor increasing substantially. I'm sure you've seen that. The cost of material increasing substantially, and frankly, the cost of housing, or the cost of real estate increasing along with that. Whenever you have to pay more people more money, whenever you have to spend more money on things, the cost of that piece of real estate goes up. Now, like I said earlier, we used to, in the residential side, we used to write insurance based off, $100 a square foot, 120. Last year we spoke with a gentleman who's a home builder. He's basically building, realistically, and this was a year ago, at $150 a square foot. So with that, we're seeing insurance carriers want people to increase the value that they're insuring their properties at as well. And that, again, kind of makes the perfect storm we're in, where premium is increasing, minimum premiums are increasing. So even if you have a policy that's, let's call it, the minimum payout you could expect out of a policy, what that minimum premium would be, let's say it's a residential property. Let's say that used to be $500, that's now going to be $1,000 or whatever it may be, which we do see quite a bit. So it's, like I said in the beginning, it's not necessarily good news, but I mean, if you can get out in front of the cost analysis and kind of realize what it would be, we have the ability to throw any property into a cost estimator, tell us what it would be to rebuild that. But I think just being prepared for increases, I think that's realistically what we should do for your listeners. I think we'd be doing a disservice otherwise. But
yeah. I think one other thing just to throw out there that I think, me and John are guilty of it, being in the business ourselves, but you get to a point where you're running so hard and you're managing all these different aspects that if the wheel's not broke, I don't need to fix it, right? And so there's so many people that have had an insurance agent for forever. They can just call him at it. Everything's taken care of. They don't have to mess with it. And at the end of the day, to go back to what John was talking about, every policy has co-insurance built into it. So whether you've looked at it in 10 years, 5 years, or whenever, this co-insurance, the insurance company knows they've got you if you don't have insured to value. And so many people are not reviewing it and really looking at it. Because let's be honest, no one wants to sit there and call their agent and go, hey, that was at this value. Let's bump that by 20% so I can pay more premium. Right. No one wants to do that. I get that.
No one does that.
As an investor myself, but at the same token, most 90% of the clients I talk to have never even heard of co-insurance or know how it reacts. And so they don't know that, okay, that's great. You can insure it wherever you want, but the insurance company has a catch in there to make sure they've got you where they need you. And so you just really need an agent that's on top of it and reviewing it. And so I just, that's number one. The second thing I would say to pay attention to in a hard market is that you're going to see in that lovely 300 pages they send you every year, a lot more terms and conditions. And so all of a sudden, you're going to have that same policy you've had for 10 years, and they mail it to you. You don't think anything of it. But all of a sudden, they put in there a vacancy clause that that property is vacant for over 2 weeks, no coverage, period, no matter what happens.
Wow.
And no one takes the time to read that 300 pages unless you got truly an advisor that's telling you what that says. Another one that we're seeing that's getting thrown on a ton of policies is safeguard policies. The agent's sitting there throwing in there saying, yep, it's a monitored home alarm and fire system. Don't worry about it. Let's get that 10% discount. Well, then they get the policy in the mail and has a safeguard discount, which says, hey, if you don't, you can have a fire alarm and burglar, but if it's not monitored by someone, no coverage. And so just be careful, because as this market hardens, you're going to see more and more of that stuff thrown in the policy and stuff you wouldn't expect from certain carriers.
So it's not even that they'll claw back that discount. It's that your property is not covered.
They can deny a claim based off that. Yeah, absolutely.
If they have it built in that policy, that's why you need to review that policy or have someone you trust, because at the end of the day, there's a reason they send you 300 pages every year. And you just got to have someone that's truly advocating for you and understands that, inside and out. What we find, and me and John both, we've talked about it because, again, we're on both sides. We buy real estate insurance and we sell it. And there's just a lot of good old boys that you can't help but to like, that are great guys, great personalities. You love to spend some time with them and buy some insurance, but they have no clue what they're selling. And most times the insurance, the client has no idea what they're buying. They're trusting you to put the right thing in place.
Yeah. Interesting. Scary. Let's talk for a second. Let's talk for a second on what I think is called earned premiums, meaning you can either pay for a policy up front. 100% earned premium means you pay for everything up front. You're committed for the full year of insurance, or a partial earned premium, like a 25% earned premium means you pay for 25% up front. You're locked in for 3 months, 25% of the year, and then the rest you pay month to month or whatever. Does that allow you to cancel? If you've got 100% earned premium, means you paid for everything you're in for the year. 25%, does that mean that you're in for 3 months and then you can cancel after that? And what happens generally? I mean, do people cancel in the middle of policies and switch to a different carrier, or what do you generally see in the market?
Minimum earned premium, just like you described it, 25% means 3 months. You have to have that coverage in place a minimum of 3 months. On the E&S side, which is typically where we see a lot of multifamily properties, they're either going to have a 25%, 50%, or 100%. And again, I think we'll see more towards that 100%. The 3-month minimum earned premium, that can still be financed. You don't necessarily have to pay that 3 months up front. Typically, Kyle, correct me if I'm wrong, is it 20 or 25% we see down payment on finance premium?
Yeah, normally 25%.
Yeah. So it's kind of in there. It's kind of built in there already on that end. Now, you're exactly right. If you wanted to shop out coverage, you can after that 3 months, or you can shop during that 3 months and cancel day of that 3-month window and not have any sort of penalties. Whereas with 100% minimum earned, you're going to have just that penalties associated with it.
So, and that's one of those things you really need to have an agent just review the policy, Matt. I had a client that's got some real estate there in Tulsa, some commercial, policies, and she called me and they'd taken like a 35% increase. And of course, they gave it to her a week before her renewal. And so she called me and said, man, I know it's not enough time. Can you look at it? We quoted it. We were able to even save a premium from the year before before the increase. We were going to save them money. And so I called her back and I said, hey, before we do it though, send me your policy. And she sent it to me and it had a minimum earned of 3 months on it. So I just said, hey, let's wait till these 3 months are over and then let's write this. Because if not, you're going to pay me and them. And I don't care what I'm saving you. It's not going to be worth it.
And what happens then if you have a 3-month earned premium, month 4, you switch and you realize, I do want to file a claim for that hail damage that we experienced during the period when I was in that 3-month period, in that 3-month window with the last insurance company. Is that okay? Or are you no longer covered? How does that work?
Again, it depends on your policy and how the policy is written, right? That's where you got to have an agent that truly understands forms and knows how it's written. But most times they'll prorate it to the day, right? And so if it's a minimum premium of 3 months and you cancel on month 4, they're going to prorate it to the day. If you cancel it 2 months into the policy, they're charging you for 3 months no matter what, whether they have it insured or not.
And so once you've switched your insurance, can you still file a claim against your old insurance?
Absolutely, because that claim is going to respond for when the actual date of the loss.
Interesting. Very interesting. What are you guys reading, listening to podcast-wise? How do you stay kind of up to date on commercial insurance, breaking news, and stay on top of your industry?
Insurance Journal. Well, first and foremost, if you're looking for an easy way to go to sleep, go read some insurance publication. But Insurance Journal is one that we both really subscribe to a lot. I do have an article I'd like to share with your viewers if you want to put it for them to look at as well. That really gives a very doom and gloom look of the market ahead. But with that, we get a lot of quarterly updates from the carriers that we write a lot of business through that kind of give that information as well.
And again, Matt, we nerd out on insurance and then have probably too much insurance stuff that we read. But at the same token, we're probably just like you guys. Me and John talk constantly about bigger pockets, and sharing articles between that. There's more. So yeah, we have our insurance that we nerd out on, and we're probably the only ones that enjoy that. But we also love bigger pockets, and I listen to a lot of leadership podcasts, and so there's a number of areas we kind of pull from.
Cool, I love it. John Melton's a military veteran commercial insurance broker with RCI Insurance and has a bunch of amazing side hustles, including aviation and real estate investment in other businesses. Kyle Beggs is his business partner in commercial insurance at RCI and also owns a bunch of single family homes that he self-manages. We appreciate you guys being on. You guys see a lot of entrepreneurial activity. You guys are entrepreneurs yourself, and we appreciate your perspective on the world of commercial insurance, which is lost on most of us for sure.
I enjoyed it, Matt. Thanks for having us on.
Hey, thanks for having us. Really appreciate it.
Take care, guys.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.